All right. Good morning, everybody. Good morning to all you wonderful melon heads out there, and happy Friday, everybody. Today is October. Today is August 11th, 2023. What's going on this morning? Fear is going on this morning. Maybe that's a little over the top, but fears of rate hikes are coming back this morning. Just a few days away from peak pivot talk when everybody was saying they're done and the Fed is going to start cutting any day now. The CPI came in yesterday, a little bit higher than expected, or pretty much, actually it was a little bit lower than expected, but a little bit higher than last month. CPI was a nothing burger yesterday. But this morning, we got PPI came in, producer price index, not the consumer price index. This is further upstream in the supply chain. The producer pricing index, that came in higher than expected. CPI not rising as much, PPI rising. That's profit margins getting squeezed by companies. Look out for that one. And notably, in the PPI report that came out this morning, services was really what was driving the rise in producer prices. The index for services rose 0.5%, where the index for goods rose just 0.1%. Now, the reason why I call out services and why that's so important, remember what Jerome Powell has told us in all of these FOMC press conferences over the last few months. We live stream every one of them. He's been talking about core, non-housing services, that those are the numbers that he needs to see come down for him to think they finally got inflation defeated. Core non-housing services, which means food, energy, and housing out. Everything else needs to get cheaper, which food, energy, and housing, what's that, like 95% of the average middle-class budget right there? But I digress. He wants to see those core non-housing services coming down, and they're not coming down. Everything else is goods inflation just 0.1% in the PPI this morning. It's almost nothing. But those services are staying high. Things like insurance, things like airline flights. Thank you, Taylor Swift. By the way, if I hear Swiftonomics or Barbienomics one more time, I'm going to hurl. I'm so sick of hearing those stories. But the inflation in services is a problem for the Fed. And to be honest with you, I think the market is discounting just how worried the Fed is right now. We've got stories about these wage increases at UPS, at the airlines, what the UAW, the United Auto Workers, is asking for. The Fed is worried about wage inflation, guys. They've been telling us they want to see demand come down. That is Fed speak for they want you to be poorer so you stop spending so much money. That's how they want to fight inflation. And they're telling you you're welcome when they say that. Isn't that great? Isn't that nice of them? After making themselves rich, so much so that two of them had to quit because of insider trading last year, now they're saying the only choice is to make you guys poor. Well, everybody's worried about that this morning from the Fed. And it's not just here in the States, you guys across the pond in the UK. UK GDP came out last night while we were all sleeping cozy in our beds. Everybody except Dad, whose back was hurting him this morning. Hope you're feeling better, Dad. Well, the UK GDP rose more than expected. And now everybody is worried about more rate hikes from the Bank of England, from Andrew Bailey, the head of the Bank of England, who had his famous soundbite recently when he said, people just need to stop asking for wage increases. People need to stop asking for raises. That's how we're going to beat inflation in the UK. Talk about a let 'em eat cake moment. The head of the Central Bank of England literally told people who have been made poor because, I don't know, maybe their utility bills quadrupled over the winter. And Andrew Bailey says, don't you dare ask for a raise. That wouldn't be right of you to do that. After Andrew Bailey got incredibly wealthy because he owns a lot of assets that went up in value with the price of inflation. Holding the beer, or he's got Marie Antoinette holding his beer over at the Bank of England. So everybody's worried about what the Fed is going to do and what the Bank of England is going to do this morning. That's got interest rates rising, and that's got stocks heading lower. And with that, we're going to shrink my big melon of a head. And while we're shrinking my head, won't you please expand that like button, everybody, for the YouTube algorithm? Really does help me out. And if you're new here, won't you please subscribe? We do this every morning with our morning updates. And the first thing this morning, the Fear Greed Index is at 64. That's down from the close of 67 last night. So market is still running on greed. but a little bit more in the fearful direction this morning. Only a little bit, but at 64, well off these recent highs. We were up in the 80s for almost a month, up above 70 for 2 months. The market is starting to get a little more fearful, but still well into greed territory. S&P this morning is down 18 points or 0.4% at 4,452. The Dow is down 74 points, 0.2%, 35,102 points for the Dow. And the NASDAQ leading the way lower this morning, down 0.7% or 96 points. Almost a hundo down on the NASDAQ, 13,641 for the tech-heavy index. We have got the DXY, or the U.S. dollar, as measured against other global currencies. The Dixie is heading higher this morning, up 23 basis points at 102.75. This is a pretty good chart that says the market is thinking about a more aggressive Fed after that PPI. When you see the dollar strengthening, that's people betting on higher interest rates in the future, courtesy of the Federal Reserve. Looking over at the commodities this morning, we got gold trading at 1,945, even though the market, this is saying gold is down $3, but they're saying it's up 0.05%. Well, isn't that a mathematical peculiarity? That's some Aunt Kathy math right there. Silver is down 8 cents or 0.28%, trading at 22.73. We've got crude oil is up 12 cents or 0.58% at 82.95. But the big news is in the bond market this morning. This is where you need to be, folks. Looking at some yields this morning, they're up across the board. We've got the 30-year Treasury is up 5 basis points, yielding 4.29%. The 10-year is up 7, yielding 4.15. Guys, this time yesterday, we were under 4. We were at 3.99%, a 16 basis point move in 24 hours for the 10-year Treasury. That goes to show you how this Fed pivot narrative has flipped on its head in just 24 hours. A lot can happen in a day. The 2-year is up 7.8 basis points, yielding pretty much 4.9%. And the 1 month still pegged at 5.38 thanks to the Fed's overnight rate. Now, also while we're in the bond market, let's scroll up a little bit because look at what's going on in the UK today in the gilt market. The gilt is the term for the UK's long-dated bonds. And guys, you may recall that the big problem back in October, back in November, was a rise in interest rates in the UK. Almost blew up the whole pension system in that whole country. It didn't get much coverage in the mainstream press. The financial press talked about it, but they weren't properly hedged against rapid rises in interest rates in the UK's pension system. And the Bank of England, while raising interest rates, had to start printing pounds in the middle of the night and buying bonds in order to bail out the pension system. This happened just a few months ago, and interest rates in the UK are higher now than they were back then. I hope the UK pension system took the opportunity they were given to hedge against further rate hikes because those further rate hikes are coming and those higher rates are here. The UK 10-year gilt is up almost 18 basis points at the moment, yielding 4.55%. Big moves in the UK bond market. Central banks, this is fears of central banks driving interest rates higher this morning. And why is that in the UK? Well, UK's economy surprise strength puts more BOE rate hikes on the table. This is dated just this morning. Britain's economy eked out an unexpected growth in the second quarter, laying the ground for more interest rate hikes from the Bank of England, but it remained the only big advanced economy yet to regain its pre-COVID 2019 level. Official data on Friday showed that the economy in the UK grew 0.2% in the second quarter against the consensus for a flat reading in the Reuters poll of economists. The figures sent the pound sharply higher against the US dollar and the euro. Now, guys, this is another case because central banks rule the world, not the free market. Central banks, this is another case where good news is bad news because of the stupidity of our central banking system. Economic growth is supposed to be good news for people. Economic growth is supposed to mean people are prospering, more goods and services are being produced. That's in a real world free market economy, but that's not what we have. We have a world ruled by central bankers who exercise the kind of power that the kings of old used to wield. And the plebs are doing well. Well, we better put a stop to that. We better hike those interest rates and put the plebs out of work before they get a raise. Remember that WTF happened in 1971 chart, the growing gap between productivity and compensation? It's because every time the economy starts to expand, First, the assets go up in value and the rich get richer. Then consumer prices go up and the poor get poorer. And lastly, wages start to rise. That's when the central banks come in and they see the wages starting to rise and they slam on the brakes of the economy and they put people out of work so those wages never get a chance to rise. Rinse, repeat that cycle for 50 years and you end up with the wealth gap that we have in the world today. That's why the markets are down on otherwise good economic news, because they know what the central bank is going to do. And here is the UK's, this is their monthly GDP, their monthly year-over-year change in GDP. That's a mouthful, 0.9% higher after a negative 0.3% reading last month. But let's also talk about producer prices. This is from the U.S. Bureau of Labor Statistics, and this is what's driving the narrative in U.S. markets today. This one just came out at 8:30 a.m. this morning. The producer price index for final demand increased 0% in July. That's higher than was expected, and that's seasonally adjusted, of course. The U.S. BLS reported today final demand prices were unchanged in June and declined 0.3% in May. So we have a 0.3% increase in July after flat last month and declines the month before that. Now, in July, the increase in final demand prices was led by a 0.5% rise in the index for final demand services. Prices for final demand goods edged up 0.1%. And again, guys, that's that big one right there, the increase in final demand prices for services rising 0.5% in the month. The Fed is not going to like that. All right, the Fed wants to see core non-housing services slow down the increase. This isn't that. This is the opposite of that. So right now, the odds of a Fed rate hike should be going up. Emphasis should be. And I just want to show you a chart. This is PPI going back for the last couple of months here. You can see we had a flat reading last month. We had a negative 0.4 the month before that, up 0.3 now. That is a pretty big increase. So this is more inflation. Now, I just want to add producer pricing inflation coming in hotter than expected after CPI came in lower than expected. That means producers' prices are going up, but they're unable to pass those higher prices on to consumers because consumers are broke and $1 trillion in credit card debt. That means profit margins are being squeezed by these interest rate hikes. And when profit margins get squeezed, the first thing employers do is they start cutting back on hours. We've already seen that in the jobs numbers. The next thing that comes is layoffs. And that is what the Fed is trying to engineer with these rate hikes. They're trying to put people out of work to fight inflation. And this morning, I'm looking at the CME interest rate futures. This is the odds of a Fed rate hike in September. Right now, only 13.5%. I'm going to refresh this because it could be changing right now. Still 13.5%. So the market is saying basically it's a sure thing that we will not get a rate hike in September. That's not a big surprise. Everybody, the Fed has been saying they're going to skip a month. They're going to hike every other month. So this 13.5% odds of a rate hike in September doesn't surprise me. I really doubt they're going to hike in September. Probably almost no chance that they do that. But interesting this morning is in November, now they're saying a 35% odds of a rate hike in November. Now that is up from a few days ago. So the market is now starting to say, we know they're not going to do anything in September, but the next meeting after that in November, now we've got a third of people saying they might hike. That is an increase in the fear of a Fed rate hike. That is up from yesterday. I took this snapshot yesterday of this same chart, the odds of a November rate hike, and you can see here it was 28%, 27.7%. That was yesterday before the CPI reading came out. Now that dipped down into the low 20s. It was like 22, 23 yesterday afternoon, but you can see now it's back up to 34.5. So the PPI coming out hotter than expected, that has people betting November rate hikes are back on the table. And guys, I think even this is way too low. I think after this report, there is a very strong likelihood of a November rate hike. I think the only way we don't get a rate hike is if we get some kind of massive credit event, which would be so bad it doesn't matter at that point about the rate hike. And looking this morning at the 10-year Treasury yield, guys, I just want to mention this chart. I had drawn this line a little while ago, and I was saying watch that 4.07% level. That connects the recent highs from the last few months. And I said we were probably going to break above it, but I wanted to see a retest and a move higher. Well, we did break above it. We came right back down earlier this week. We were pretty low yesterday. Now we're back above it. So we failed the first retest. I wonder, are we going to get another retest and then finally a move higher in yields? But we'll keep an eye on that one. Right now, yielding 4.14. Again, that's up 15 basis points just over from a day ago. All right. One more thing I want to talk about, guys, is we have been mentioned in this one. We are moving. I mentioned this a few times. The stream, I put out a poll. 80% of you said you would rather see the stream at 9 a.m. versus 9:30 a.m. so you don't have to split your attention between the opening bell and what Jack is talking about. So effective Monday, we will be going live at 9 a.m. versus 9:30. We're moving up a half hour. So make your coffee a little bit stronger on Monday for the live stream. We will be going up earlier. Keep an eye out for that one. And don't worry, you 9:30 people, you can still catch the stream. You just won't catch it live. And I also have to say some thank yous to Mr. Steve Woitis. Thank you, Steve, for the super chat and the support of the channel, sir. He says, if new bond coupons keep rising, do you think the bond market will take investor dollars away from stocks? Yes, I do think that's happening. But let me float this idea past you, Steve, and that's a good idea. Why buy overpriced stocks that are yielding 2% in dividends when you can buy a 1-month treasury at near zero risk for 5.5%? But I would ask you this, what happens to banks? Because, I was talking to my dad and my uncle yesterday, and almost everybody I talk to now, anybody who really pays attention in markets, is starting to buy short-term treasuries because they're not going to leave their money in the bank where they're going to get 0.1% interest from their savings accounts from JP Morgan Chase, when you can park your money risk-free in a 1-month treasury and get 5.4% or 5.3% on it. So more so the system with the rise in short-term rates, I'm less worried about stocks than I am about banks. Because if more people start parking their money in short-term treasuries, that means they're taking the money out of the banks and that the banks need to meet those withdrawals. Well, how do the banks meet withdrawals? By selling assets. And remember back in March and all through May, Silicon Valley Signature Bank, Silvergate Bank, First Republic, Credit Suisse, PacWest, all the banks that went down. I'm sure I forgot one. Who's keeping track? The banks are having to sell assets at a loss in order to meet withdrawals, and that's what's been driving these bank failures. So the short-term interest rates on U.S. Treasuries could be aggravating the bank run. Almost everybody I talk to who follows finance closely is taking money out of the banks and putting them in short-term U.S. Treasuries. So if these bonds keep rising, if these interest rates keep rising, be worried about the banks. And also keep in mind, interest rates rising, that is bond prices going lower. Well, the banks bought all those treasuries back in 2021 and 2022 when everybody got their stimmies. Remember that inverse relationship between bond prices and bond yields. As bond yields rise, bond prices go lower. So be worried about stress in the banking system, because stress in the banking system will send those stocks lower. Absolutely. But stocks going lower, that is the symptom, not the cause. It's the banks you got to worry about with these higher rates. It's the likelihood of some kind of a credit event. It's also you got to worry about companies going bankrupt because they can't make their payroll because their interest rates. Oh, and let's not forget about commercial real estate. And oh my God, what's going on in commercial real estate? So thank you very much, Steve. But don't worry so much about the stock market. I'm telling you, pay attention to the bond market because the bond market is the economy. The stock market just gets all the press. The bond market is where the moves happen. Thank you very much, Steve. I appreciate that very much. And the last thing I got to talk about today, guys, is the Silver Symposium at beautiful Caesars Palace in Las Vegas on September 29th to October 1st. If you haven't gotten your tickets already, what are you waiting for? There's just 49 days left, and they are running out of tickets fast. This is a fantastic event. I will be there speaking. My buddy, the Ninja, will be there. Dan from I Allegedly. Chris Taylor from Financial Prepper is going to be there. A whole bunch of other YouTubers. Andy Scheckman, David Morgan, everybody in the precious metal space. It's a fantastic time. I want you guys to come out and meet me. And when you see me there, I want you to walk right up and say, hey, Jack. Start telling me about what you're seeing in the world. I love meeting you guys at these events. I love hearing about what is going on in this industry and that industry, and sales are up or sales are down. We're busy. We're slow. You get this beautiful picture of everything going on in the economy. So come on out to the Silver Symposium. There is a link down below, and I'm going to pin it in the comments also. If you use that link, you'll get 10% off your tickets. Full disclosure, that is an affiliate link. All right, guys, I want to say thank you so much. Thank you, Steve, for the super chat, the support of the channel. Thank you to all my Patreon supporters for everything you guys do for the channel. You guys are awesome. I also want to say hi, Mom, hi, Dad, and also hi, Aunt Diane and Uncle Norm. I know you guys are in the car with them, probably listening to the stream right now. Love all you guys. And until next time, live small and dream big.